Chapter 17: Banking and Financial Services. The Federal Reserve System was set up to supervise and regulate member banks and to help banks serve the public efficiently. All national banks are required to join the Federal Reserve System. The most common way for a bank to be organized is as a commercial bank. Commercial banks are often called full-service banks because they offer a wide range of financial services. Commercial banks offer checking accounts, savings accounts, make loans to individuals and to businesses, and offer several other services. There are 4 basic types of banking services that most people will use. The first one is savings accounts. The second, checking and payment accounts. Third, loans and other credit plans. And 4, other services such as safe deposit boxes and investment advice. An endorsement is written advice that you received payments or that you transferred your right of receiving payment to someone else. An endorsement that consists of only the endorser's name is a blank endorsement. A blank endorsement makes a check payable to anyone who has the check. While you can use this endorsement to transfer any check, sometimes another type of endorsement is better. The use of a full endorsement, also called a special endorsement, allows you to transfer a check to another person. You write the words "pay to the order of," followed by the name of the person or business in which the check will be transferred to. A restrictive endorsement limits the use of the check to the purpose given in the endorsement. For example, you may have several checks that you want to mail to the bank. You could write "for deposit only." This means that is restricted only to be deposited into your account. Chapter 18: Consumer Credit. There is 2 main types of credit: trade and sales credit. Most businesses use trade credit. Trade credit occurs when a company receives goods from a supplier and pays for them later. If you charge a purchase at the time you buy a good or service, you are using sales credit. Most businesses offer sales credit. A finance charge is the total dollar cost of credit, including interest and all other charges. You must pay this additional amount for the convenience of using credit. A loan is alternative to charge account, buying, or installment sales credit. The terms of the loan and the requirements for securing the loans differ from one another. An installment loan is one in which you agree to make monthly payments in specific amounts over a long period of time. The payments are installments. The total amount you repay includes the amount you borrowed plus a financial charge. Another type of loan is a single payment loan. This type of loan, you do not have to pay anything until the end of the loan period, which normally is from 60 to 90 days. At that time, you repay the full amount you borrowed plus the financial charge. When a person takes out a loan or borrows money, it has a cost. Interest is the cost of using someone else's money. The amount of the interest paid on a loan or charge account should be clearly understood in the first place. Banks put an interest rate on their loans because that is how they make their money. The customer has to pay back more money than what they borrowed, which leaves the bank with extra money in hand. Businesses need to consider the 3 main factors when a person wants credit. These are known as the 3 C's: character, capacity, and capital. Character refers to your honesty and willingness to pay a debt when it is due. If you have bad history of paying bills, creditors believe that you are at a bad credit risk. The second C is capacity. This refers to the person's ability to pay the debt when it is due. The lender or seller must decide if you have enough income to pay your bills. If your income is too small, granting you credit may not be wise on their part. Capital is the value of the borrower's possessions. Capital includes the money and property you own. Your capital may include a car that is paid for and a house on which has a large amount that has been paid. Having capital gives the lender some assurance that you will be able to meet your credit obligations. Chapter 19: Savings and Investment Strategies. Savings is the storage of money for future use. How much you save, where you put your savings, and what you save for are important decisions. Some people save for years and then use those funds that they saved to put a down payment for a home. After building up some savings, most people want to earn more. Investing means using your savings to earn more money. While a savings plan is a simple type of investing, many other investment choices are available. One form of investing money is putting it into stocks. Putting money into stocks is giving a business money to help their business grow, and whenever their business does grow, they give you money back in payment as saying thank you for helping their business when it was small. Sometimes unexpected bills come up and you need cash quickly. Investments that can be turned into money quickly are called liquid. Liquidity is the ease with which an investment can be changed into cash without losing its value. There's two types of stocks: preferred and common stocks. Preferred stock has priority over common stock in the payment of dividends. The dividends paid to preferred stockholders are usually limited to a set rate. Investing in preferred stock is less risky than common stock because preferred stocks generally have no voting rights. Common stock represents general ownership in a corporation and a right to share in its profits. Common stock has no stated dividend rate. Common stockholders are entitled to one vote per share of common stock owned. Common stockholders receive dividends only after preferred stockholders are paid their dividends. Chapter 20: Insurance. Owning a vehicle puts you in a position of high economic risk. You may have an accident or injure yourself or other people. You might damage your vehicle or others' property. Your vehicle may be vandalized or stolen. Someone could sue you because of the accident. Sometimes accidents cannot be avoided. The person who is legally at fault is liable for damages and financial losses that result from the accident. All of these reasons show how important it is to get insurance on your vehicles. Insurance protects you from the financial loss you would incur if something of your property were lost or damaged due to fire, theft, vandalism, flood, or other hazards. Property owners are often at risk. Home and property insurance protects you against three kinds of economic loss: damage of your home or property, expenses you must pay to live somewhere else if your home is damaged, and liability loss related to your property. When buying life insurance, you must name a beneficiary. A beneficiary is the person named in the policy to receive the insurance benefits. The beneficiary is most often a spouse, children, or other dependents. Several types of health-related insurance are available to provide different kinds of coverage. One type of health insurance is medical insurance. It can be classified under 5 different types. The 5 types of medical insurance is hospital, surgical, regular medical, major medical, and comprehensive medical policies. Insurance companies offer a combination of policies between all 5 of these.